Bitcoin, the most prominent cryptocurrency, is often hailed as a revolutionary alternative to traditional finance. However, beneath the glossy narratives of decentralization and digital freedom lies a deeper issue. Bitcoin is not the cure for a dysfunctional financial system, it is a symptom of it. Moreover, its market behavior over the past decade increasingly exhibits characteristics of a speculative bubble, divorced from economic fundamentals. The reflection of a broken system. Bitcoin's rise can be largely attributed to a loss of faith in mainstream financial institutions, especially in the aftermath of the 2008 global financial crisis. Central banks, particularly the U.S. Federal Reserve, injected massive liquidity into the system through quantitative easing, keeping interest rates near zero for over a decade. While these policies were intended to stimulate growth, they also fueled asset inflation and wealth inequality. Bitcoin capitalized on this disillusionment, presenting itself as a decentralized and deflationary alternative. Yet Bitcoin's role as a financial escape hatch highlights rather than solves the problems of modern finance. It does not provide credit, facilitate productive lending, or stabilize markets, key functions of a sound financial system. Instead, it encourages speculative behavior, hoarding, and price volatility, all under the guise of financial innovation. Extreme volatility and lack of utility. One of the most glaring issues with Bitcoin is its extreme price volatility. A functional currency or store of value requires price stability. Bitcoin, however, has seen price swings of over 80% within a single year, far from what can be considered stable or reliable. Such unpredictability undermines its use as a medium of exchange or unit of account, relegating it to the realm of speculative assets rather than practical money. Moreover, Bitcoin's practical utility is limited. Its transaction throughput is low compared to centralized payment systems like Visa or PayPal, and transaction fees have at times surged beyond what's reasonable for everyday purchases. The slow confirmation times and high energy consumption further erode its real-world usability. Bubble characteristics. Bitcoin exhibits classic signs of a financial bubble. Its price surges are often driven by hype, retail FOMO, fear of missing out, and influential endorsements, not intrinsic value or productivity. Similar to historical bubbles like the Dutch tulip mania or the dot-com bubble, Bitcoin's price has repeatedly disconnected from any measurable economic utility. Additionally, the concentration of ownership is concerning. A small number of wallets hold a significant proportion of all Bitcoin, leading to price manipulation and liquidity risks. When the asset is controlled by a few but hyped by many, it's ripe for instability. Conclusion: Bitcoin is less a solution to financial dysfunction and more a mirror of it. It thrives in an environment marked by distrust, inequality, and speculative excess. While it has sparked important conversations about monetary policy and decentralization, its inherent flaws, volatility, limited utility, and bubble-like behavior, make it an unreliable foundation for the future of finance. Rather than reforming the system, Bitcoin may merely be exploiting its weaknesses for short-term gains.